Oil is still trading around $76 per barrel. Market participants have already priced in the fact that Russian oil is significantly below the price cap set by the European Union. Apparently, this is the reason why Russia is not yet in a hurry to take relative measures. At the same time, it convinces many investors that Russia has actually come to terms with a price ceiling, which in turn is exerting pressure on oil prices. Paradoxically, it turns out that oil prices may gain value only in the case of some retaliatory measures, but Russia does not introduce them due to the low level of prices. However, this cannot last for long. From a political viewpoint, Russia is forced to respond to the EU restriction. The only question is when exactly this will happen. Everyone expected Moscow to make a comment at the end of last week, but on Saturday the Kremlin officially announced that the issue was still under consideration. However, if the situation does not change in the coming days, investors will most likely shift their focus to an easing of the quarantine measures in China. This will inevitably lead to a rise in oil demand and accordingly higher prices. Perhaps soon afterward, Russia will finally respond to the price cap. From a technical point of view, Brent crude oil futures lost more than 11% over the past week. The quote overcame a number of important price levels and closed at the marks recorded in December last year. According to short-term and intraday time frames, the asset has slipped into oversold territory, but speculators are so far ignoring this signal. Thus, if the price fixes below $75, it will most likely extend losses, heading towards the level of $70. Now let's move on the dollar-ruble pair. Although inflation in Russia slowed down to 12% from 12.6%, beating a 12.2% forecast, the ruble remains stable. Moreover, the amplitude of its fluctuations somewhat decreased. Nevertheless, the uptrend is still intact, even though the price is currently pulling back from the area of 63.5. Thus, if the price returns above the 63 ruble mark, the volume of long positions will increase again. And in this case, the pair is expected to rise above the local high of 63.5 and then hit for the key resistance level of 65. At the same time, the dollar is being wound down by the upcoming meetings of the US Federal Reserve and the Bank of Russia, to be held on Wednesday and Friday respectively. The Russian regulator is expected to keep interest rates unchanged. That is, the central bank will apparently take a break from a monetary policy easing, which in turn reduces downside risks for the ruble. Meanwhile, gold traders are waiting for results of the ECB and the Fed meetings. Against the backdrop of these expectations, the precious metal has even tried to rise above $1,800 per ounce. Market participants believe that both regulators will lift the interest rates only by 50 basis points this week. In this case, the market will hardly see major changes, as traders have already priced in this fact. However, one of the central banks may well raise the financial rate by 75 basis points, which will lead to a sharp drop in the volume of the yellow metal. To extend gains, the quote needs to settle above $1,810 on the 4-hour chart. Until then, there is a likelihood that the current bounce may be replaced by a downward move towards the level of $1,765. And that's all for now. We wish you profitable deals. See our channel with a new video in a couple of hours.